I want you to imagine something. Imagine you are a basketball coach who's tasked with picking a team of 7 players for your local city tournament. You've been asked to show up at a weekend where hundreds of people will show off their skills to join the city's basketball team. This is a prestigious tournament and the stakes are high. Cities compete for pride and records go into the history books. How will you pick your 7 players? I personally start with a set of parameters or criteria that I'm going to look for in players. For instance, in basketball, it's a huge advantage if you are tall. So if anyone is below 6 feet, no matter how good they are with their technical skills and perhaps how fast they run, they will simply not make the short list of 7 people. Because in basketball, as a generalization, tall people will always outperform shorter people. Now, why am I asking you to imagine a scenario of being a basketball selector? For one, I learned of this analogy from the great Warren Buffett. 2, as investors, we need to be able to quickly screen out stocks. There are hundreds of options to choose from and time is limited. How will we select stocks? So in this video, I'll share 5 ratios that are non-negotiable for me when analyzing stocks. I'll start with one of the most important considerations in terms of investability, which is to figure out if the business is free cash flow generative. So what is free cash flow? This represents surplus cash that is left behind from the company's operation after it has provided for its capital expenditure needs. Free cash flow is calculating using the following formula: cash from operations minus capital expenditures. So this is a key indicator of a business's financial health, as it tells us the ability to generate cash, which can be used for various purposes like paying dividends, buying share back, investing in growth-oriented projects, etc. So you might be wondering, why not use net profit? This is something I was curious about and did research on. Essentially, free cash flow is more accurate of a measure of a company's performance than net income because it accounts for cash outflows needed to sustain the company's operations and growth. And so it's a more accurate measure than net profit. Next, I look at return on equity, or ROE. This is the profit a business earns after paying taxes as a percentage of shareholders' equity. So ROE is calculated using this formula: net income divided by shareholders' equity. Essentially, ROE indicates how effectively a company is using the money invested by shareholders to generate profits. The next metric that could be an indicator of a great business is ROCE, or return on capital employed. ROCE measures a company's profitability and the efficiency with which its capital is used. It measures the cash flows generated by a firm per unit of capital involved. And the formula is earnings before interest and tax, EBIT, divided by capital employed. If the ROCE earned by a business is less than its cost of capital, it's unable to pay the capital providers for the use of this limited resource. This can destroy value for shareholders, as they could be using the capital elsewhere and getting higher returns. Generating healthy ROCEs can be even more challenging than generating healthy cash flows, because over a period of time, this is a measure of how well a company reinvests its excessive capital. There are some companies with this problem where they make a lot of money, they're free cash flow generative, but their business model does not allow for all of this extra capital to be invested well. So with ROE and ROCE, I typically look for higher than 15% for both of these metrics. Before I go on to the fourth metric, what we're trying to do with these is to identify a high quality business. I want to share a quote from Warren Buffett, who says, "The ideal business is one that earns very high returns on capital and could keep using lots of capital at those high returns. I mean, that business becomes a compounding machine." Let's move to the fourth metric that I use to filter out stocks. The debt to equity ratio measures a company's financial leverage by comparing its total debt to shareholders' equity. It shows the proportion of debt and equity used to finance the company's assets. The formula is total debt divided by total equity. Huge amounts of debt and being highly leveraged increases the riskiness of an investment. So as a general rule of thumb, I avoid companies that borrow lots of money to grow or have crazy amounts of debt. Companies in industries like real estate or steel need leverage to grow revenues, and I generally stay away from real estate companies. And finally, I look for a sales growth of at least 10% in the last 5 years on average. This one is a no-brainer, as you want to invest in companies that are growing and have a solid runway ahead of them for growth. So to summarize, the reality is that there are thousands of stocks, and these 5 key financial metrics help us to narrow down stocks. The good news is we can use publicly available information in annual reports, tools like screener.in to find these ratios. We don't have to calculate them ourselves. However, it's a good idea to validate numbers from multiple sources to make sure that your input, your data point is accurate. So I hope you found value in this video. If you did, please like the video, subscribe to my channel. Thanks for watching, and I will see you next time.